Morning all. I'd like to welcome you to this seminar of the Carnegie Endowment for International Peace on Is the Global Recovery for Real? My name is Peter Bartalier. I'm a professor at Johns Hopkins SAIS and as of today a visiting scholar at the Carnegie Foundation, the Carnegie Endowment. It's my pleasure to introduce the subject and the speakers. The subject requires very little introduction. All of you have been following this monster recession, as I'm sure a few others in this town. The four speakers we have on this subject are all very experienced professionals who follow this recession, write about it, make global projections for a living. On my right, far right, we have Hans Timmer, who is responsible for long-term global projections in the World Bank. On my left, Mr. Jörg de Crescin is doing something similar for the IMF, and both have extensive support staffs to help them in this enormous task. On my right is Mr. Philip Suttle, who is doing very similar work for the Institute of International Finance here in Washington. Is also responsible for global economic research and institute. And on my far left, Uri Dadouche, who is the head of the new global economics program that the Carnegie Endowment has started last year. All four are long-term professionals who have been doing this kind of work for a very long time. I will not spend a lot of time introducing them individually. You have the descriptions in front of you. To save time, I would like to invite the first speaker, Mr. Hans Timmer, to make a presentation and to emphasize, because of the number of speakers we have, that the speaking time will be limited to 10 minutes. Would you like to sit there or?
No, I need a presentation, so I will go out there.
Okay.
Good morning, everybody. Thanks very much. Thanks very much for the invitation. It's always a pleasure to be able to discuss this subject with old friends. Since there's only 10 minutes, let me immediately start answering the question that is on the table. Is the recovery real? My answer is that depends on how sustainable the rebound in the emerging countries is. Now you might think, there we go again. Ask an economist a question, any question, and the answer is, it depends. But there might be a little bit more information in this answer than you think on first sight. First of all, what I'm trying to say here, it doesn't depend primarily, in my view, on the rebound and the recovery in the high-income countries. It doesn't rebound on what is happening in the United States. The world economy does not depend on the spending power of the US consumer. And that might by itself be somewhat of a surprise because, of course, the crisis started in the United States. Everybody is talking about the stimulus program and what is happening in the United States. And even now in the popular press, I think recently in Newsweek, Fareed Zakaria had a whole column on it, that the only thing that matters is the US consumer. I think that's a misread of the numbers. It's a misunderstanding of what really drives the dynamics in the world economy, both in the downturn and in the upturn. So you really have to look at what is happening in developing countries and emerging economies to understand the rebound. And the second element is that, indeed, it depends. Although we do see now clear signs, especially in the emerging countries, especially in Asia, of a return to positive growth, sometimes surprisingly strong growth, it's still not clear whether this signals a clear recovery. A lot what you're seeing now in the numbers is what you can call a technical rebound. Has really nothing to do with a regaining of strength in the world economy. And also, it is not clear whether the global financial system is strong enough to support a real long-lasting recovery. So that is my answer. I will show now some graphs to illustrate the storyline behind this answer, just till the 10 minutes is over, and then I'll stop. First of all, understanding where the dynamics in the downturns and the upturns are coming from. On the left-hand side, you see what happened with trade in the first 5 months after the crisis erupted. And we are looking there at import growth, cumulative import growth for high-income countries over that 5-month period, and cumulative export growth. And what you're seeing is that for the high-income countries, the decline in export was twice as large as the decline in imports. And basically, for developing countries, you see the opposite mechanism. So what happened after the crisis was not a slump in domestic demand in high-income countries, as a result of which the rest of the world was suffering. What really happened was that the decline in domestic demand in the developing countries was much stronger. As a result of that, the high-income countries are suffering with their exports, especially countries like Japan and Germany that were specialized in investment goods. What the crisis did was make the developing countries reconsider investment projects, would make the developing countries drawing down on their inventories and stop importing. That is really what made the crisis so deep. Then if you look at the last 5 months, which you can say could be the start of a recovery, and now we are looking from the perspective of emerging Asia, then you see that emerging Asia, the picture has turned around, that the growth in imports is exceeding the growth in exports. So while the downturn primarily came from the developing countries, the upturn starts also coming from developing countries. This is another way of illustrating that same point. We look here at export growth of Japan. Japan, the country that was probably hit hardest by the crisis of all countries in the world. And we look then at contribution to that export growth of developing countries according to the country of destination. And we are looking at the impact of the United States, of Europe, and then of the whole of Asia, including the emerging Asian economies, but a big part of that is China, and then the rest of the world. And what you're seeing is that before the crisis, really Asia and China were the dominant factors explaining the growth in export for Japan. But also in the downturn, it was Asia that flipped around much more. So what happened in Asia, again with their investment process, was much more important than what happened in the United States during the downturn. And actually the downturn in the United States started much before the financial crisis erupted and became a global financial crisis. The downturn in the United States started already at the end of 2006. In 2007, there was hardly any import growth anymore. The rest of the world was still growing very fast. Now then the question is, will there be a rebound in the emerging world, in the developing countries, and is that for real? If you look at a country like China, then really something is happening over the last couple of months, illustrated here with their import demand. And again, in my view, that is a very important driver of the world economy. It will be a very important factor in the global recovery. This rebound is much stronger than what you're seeing in the high-income countries. So there is indeed a sign that the world economy is turning. Here another illustration of the role of developing countries. What we are looking here at is 3 months over 3 months industrial production growth for the world as a whole, for a high-income country, Germany, and then for all developing countries excluding China. We exclude China here because the data is pretty volatile. The interesting point made by this figure is that, if anything, the developing countries were indeed leading in the downturn and also leading in the recovery. Another illustration that you have to look at what is happening in the developing world, how sustainable is it, to understand whether we indeed will have a global recovery. Other indications that the situation indeed has changed for the better, if you look at the spreads that has skyrocketed in the developing world, the main cause why the financial crisis was affecting the developing world, those spreads have come down significantly, not yet at the level before the crisis, but we are getting close to it. So an improvement there. Also, if you look at commodity prices, that is consistent with a picture of a recovery in the developing world. We are looking here at the oil price in dollar terms, in euros, and in real terms. And the latter, that is the red line here, is the real measure of what is happening in the commodity market. A very similar picture you see for metal prices and to some extent for some of the agricultural prices. And again, what you're seeing is that over the last 5 months, the situation has turned for the better. It's consistent with the recovery in the world economy. Some people are even concerned that those prices are rising too fast and that oil prices are already at a level that might threaten the recovery. I'm not sure that that is true. Oil prices have been very volatile, but as this graph tries to illustrate, to a large extent, that was actually an exchange rate story. To a large extent, that was the story of first the weakening and then the strengthening of the dollar. If you do it in relative terms, or if you do it in a more neutral currency over the last period, like the euro, then you see a better picture of what was the real price in the oil market. That real price was very consistent with what you're seeing in the real economy, what you're seeing with total production. You saw the increase till just before the crisis, then the sharp fall and a moderate recovery. I would interpret this as another illustration that there might be a recovery on the way. But I have 2 buts to finish this presentation. First of all, when you look at the data now in the developing world, most of the recovery is still of what I would call a technical nature. What you saw was that there was a sharp decline in investments, and there was especially a sharp decline in inventory build-up. That started in the first quarter, was especially strong in the fourth quarter, was especially strong in the first quarter. And now in the second quarter, you see many countries returning to positive growth. But to a large extent, that is because the investments have stopped falling. And to a large extent, because the drawdown in inventories is no longer that large. But inventory levels are still at a very low level. Investment levels are still at a very low level. And the positive growth is because consumption, which continues to grow at a positive rate, is still there, positive, and you see a big turnaround. That is not yet a sign that the dynamics in the investments, which was so strong over the last 6-7 years and one of the main drivers in the world economy, have come back. It is just that they stopped falling. So in that sense, you can't be confident. There is a big potential for further growth, but whether that will be realized is not clear. The other one is that the biggest rebound you see in the countries that had the biggest fall. But in terms of level also of production, you are still at very depressed levels. Here it is illustrated with industrial productions in Latin American countries. In Latin American countries, what you're seeing is that a country like Chile had a relatively moderate decline, mainly driven by the decline in commodity prices, but mitigated by very solid policies at home. Mexico, very much dependent on import demand in the United States, had a decline, but relatively moderate in industrial production. The country that was really suddenly hit by the financial crisis was Brazil. And indeed, that is also the country that is rebounding now fastest. But again, I would interpret that for the moment as a technical rebound. The second but is that it is not clear that international credit supply will support the much stronger rebound that is needed in the global economy. I think yesterday Phil Suttle wrote in his daily observations that many people think that you need first a healthy banking sector before you can have a return of growth in the world economy, and he thinks it's the other way around. Actually, you need a return to growth to make the banking sector healthy. That might well be true. But I think it's important to observe that the current rebound that we're seeing doesn't need really an increase in credit supply. Perhaps China is a special case. But in most countries, the rebound that we are seeing now is not really a rebound in investments. It is not a rebound to growth rates above potential. And only when you have that kind of a rebound, you need a lot of additional credit supply. And that is still a big question mark whether we will get there. My 2 minutes are up now, probably. I want to leave it here. My main message is, if you want to discuss that, let's focus on what's happening in the developing world. There are positive signs, but there are a lot of question marks still there.
My next speaker is Jörg Dickerson.
Good morning, ladies and gentlemen. I, too, will try to have an answer at the question right away, and as usual, with a but. We think the recovery is for real, but it is very heavily policy dependent. Moreover, medium-run growth prospects, this is the second point I want to make in my short speech, are much less bright now than they were before the crisis. And this will interact with the recovery and make this a fairly subdued recovery by past standards. So let's go to the recovery. First, what you see here in the chart on the way left is an index of world trade. You can see that it has recovered. It basically makes a similar point that Peter has made. The PMI index in the middle shows you what happened to manufacturing output in advanced and emerging economies. The emerging economies are in yellow. You see they have rebounded lately. The advanced economies are in red. They have also rebounded. But note that the advanced economies are still below 50 if you move to the left. And that suggests that manufacturing activity, at least as of July, was still contracting, but at a much reduced pace in advanced economies, while it was expanding in the emerging economies. And then way to the right, you see something which is very important. It's consumer confidence in the advanced economies. And that, as you can see, has only recovered very modestly. And why is this important? It's important because consumption in advanced economies is a key driver of exports by many emerging economies. So, what has happened? Policies have been extremely forceful in addressing this downturn. The fiscal policy has been very expansionary in many advanced and in many emerging economies as well. Monetary policy has cut interest rates in advanced economies to between 0 and 1% rates that we haven't seen in a very, very long time. And moreover, has taken unconventional measures. These actions, together with guarantees for the financial sector, have essentially taken the fear of a Great Depression off the table. And this fear of a Great Depression had really caused a precipitous plunge in activity during the fourth quarter of 2008 and the first quarter of 2009. And what we are now seeing is a rebound from that. The question is, how far will this rebound go? And this, in our minds, is really a function of several factors. I would call one set of factors revolving around rebalancing. What needs to happen for this recovery to become self-sustaining is that private demand needs to step in for public demand. Fiscal deficits have been racked up. They will need to be brought down, and therefore private demand will have to step in for the recovery to become self-sustaining. Central banks have taken exceptional measures. These will have to be very gradually unwound as private demand gathers pace. And at the same time, there's, of course, only very limited room left for central banks to support the recovery further with interest rate cuts, because most of them are, in advanced economies, between 0 and 1%. So we need this rebalancing from public to private demand. We also need a rebalancing at the global level. Many countries that have run current account deficits and done so in the context of asset price booms that have now burst and are now experiencing major pain in housing markets and also in other markets, these countries will see their domestic demand slowing down appreciably. And so what has to happen for the global economy to keep growing is that domestic demand in other economies that have been running current account surpluses needs to accelerate. This is our second facet of the rebalancing that needs to happen. And what I'll argue is this is a complex process that will take quite some time. Aside from rebalancing, then there is the other consideration, which is that banking crises typically are associated with permanent output losses. And us coming out of this crisis will mean that it'll take quite some time to rebuild activity, and the recovery will therefore be quite sluggish. Let's go over some of these points now. This here shows you a picture on the top end as to what is going to happen to countries that have had current account deficits, right? We have the United States on the left, top left, and other current account deficit countries on the right. Now, these two groups accounted for broadly the same overall world current account deficit. In these other countries, you find a range of countries from the UK to Spain, but then also many emerging economies, Turkey, Slovak Republic, Romania, Poland, Lithuania, Latvia, you mentioned it, a whole bunch. And their combined current account deficit is it's just a little bit smaller than that of the United States. And what you see in this chart is that both for the United States and for these economies, many of which are in Eastern Europe, the current account deficits are narrowing already quite a bit and will be narrowing further, right? So less domestic demand from these economies. And how does this happen? Just focus on the two charts below. You can see the yellow line for the United States. It's the change in investment in percent of GDP. Now, we know that GDP has been contracted for quite some time. And we know that it'll grow very slowly, but still, investment is going to be doing even worse. Okay, so that's what's going to detract from domestic demand in the US. And you have the same with the yellow line for the other current account deficit economies. Private consumption also will be less dynamic over the medium run. It will not only in the United States fall as a share, fall in absolute, slow down appreciably in absolute terms because GDP slows down. It actually slows down more than GDP. So it's going to be much less domestic demand in the United States, and you'll have the same thing in the other current account deficit economies, which comprise a few major advanced European countries and many emerging economies in Eastern Europe. So, to address this rebalancing, what will have to happen is that demand in surplus economies will have to grow more rapidly. And these surplus economies are the likes of China, but also Germany, Japan, and quite a few others. And this is a complex process. And in many cases, people emphasize the role that China needs to play because countries like Germany and Japan have aging populations, and therefore there's less dynamics to be expected from these economies. But China accounts for, the consumption in China is equivalent to about 25% of the consumption in the United States and these other current account deficit countries. So China alone cannot do it. There are Middle Eastern countries that you can put into the mix, but they too face special challenges that mean that this rebalancing will be a drawn-out process, and therefore this recovery will be a sluggish one. It will also be sluggish because after banking crises, recoveries typically have been sluggish. What you see on the left here is a result of a study of 88 banking crises that have happened, and it plots what happens to output in the first 7 years after a banking crisis. And as you can see, it's typically around 10% below where it was before. So there's really appreciable permanent output losses following a banking crisis. And as you see on the right-hand side, these are driven by various factors. First you have a drop in the employment rate. You see that in yellow. People lose their jobs. It's usually a pretty severe recession when it's originating in the financial sector, and it takes a long time for them to find back to the labor market for various reasons. You also see in the green line that the capital-labor ratio declines, and that's because if you have a financial crisis, investment is hit particularly hard. A lot of capital becomes obsolete because economies need to reconfigure. And that means that you have lower output on that account as well. And finally, you also have lower output on account of productivity that slumps. So that's why when you look at this picture here, are forecasting a much more subdued picture for the medium run than we had before the crisis. The yellow line shows you the projection for the current account surplus countries before the crisis. In April 2007, and you can now see the red line, which is what we are projecting currently. We are roughly losing 10% of output as a result of this crisis for the current account surplus economies. For the deficit economies, things will be worse. The losses in output are larger. And as you can see in the red line, it is also sloping less upwards, which suggests that growth rates for quite some time will be lower than they were before the crisis. So we are looking at a slow, sluggish recovery. And to put some numbers around this, here are our growth forecasts and our fan chart. You can see those on the right-hand side. For the world economy, after having contracted by about 6.5% in the first quarter, we now see growth at around 1.5% for the second quarter of 2009. And in 2010, the growth rate will average right around just below 3% is what our guess is at the moment, although our forecasts are still being tied down. Moreover, as you can see by the confidence interval, it's very wide, so things are still very uncertain, and we see most of the risk on the downside. And the main risk I want to emphasize is that people mistake the recovery that we are seeing right now for a self-sustaining recovery and withdraw the policy support prematurely. Thank you very much.
Next speaker is Philip Suttle.
Well, I do not have a slideshow, so I'm going to speak from the desk if that's okay. And I'm a little embarrassed because, first of all, I don't have a slideshow, and my colleagues from the fund and the bank do, so that obviously puts the IIF at a clear disadvantage. But also, I only had 2 points to make, and Hans actually made both of them for me. So, no, seriously, I do have a little more than that, but coming third on top of two excellent, detailed, and I think basically correct presentations, I guess what I'd like to do is just sort of, take those as a given. As I say, I'd agree with most of what was said, and try and add some color around the edges where possible. And one of the things I think it's easy to do with the global economy is to get too grandiose and pretend you can talk all about the next 2, 3, 4 years with great confidence. I mean, anyone who's lived through the last 2 years should know that our ability to forecast the next 18 months is not necessarily too good at the moment. None of us, I think it's fair to say, saw the degree of the decline that we had over the fourth quarter of last year and the first quarter of this year. None of us really saw it coming. So I think it's very important to track near-term developments. I mean, I think to have any degree of confidence of where things are going, you've got to be on top of where we're headed. And I think it is worth dwelling on where we just came from a little bit. And I think it is important to note that, if you go back, especially to where we were in March, looking ahead to the second quarter, we've realistically had an unbelievably strong set of upside surprises. I mean, most importantly, perhaps, in Europe and Japan. I think it's fair to say China and other parts of emerging Asia as well. To a lesser extent, actually, interestingly, the US. And I think a big part of that was the troubles in the US auto industry, which lingered for longer than most people expected and gave US industrial production much more downside than in most other countries. But I think it's worth bearing in mind as one looks ahead that we've come out of a phase of consistent upside surprise. And I would actually say that trend in the next 6 months or so should be, I think, with a reasonably high degree of confidence, should be extrapolated. And I just want to run through a number of factors that I think are going to be quite important in giving us what I would characterize as probably surprising synchronized strength over the next 6 months or so globally. And I take a little bit of issue with Hans's point that this is all a technical rebound, because, I mean, if you're going to make that point, you probably should then say, well, it was a technical recession. And it didn't feel very technical to me. It felt quite real. So I think one has to accept that this will be a real rebound, and there may be some sort of technical issues behind it, but it is going to be for real. But let me just highlight those 6 points very quickly. Number one is the stock cycle. I think we're all on top of that point, but I think it's worth dwelling on the magnitudes here. In the second quarter, in the major economies, inventories were a pretty consistent drag on growth. And that meant that they were even more negative than they were in the first quarter in terms of the absolute change. So if we just go back, I mean, this is Hans's technical point, if we just go back to zero on inventories, that's a massive positive contribution to growth that, in my opinion, is likely to come through steadily rather than suddenly in coming quarters. Second point, easier global financial conditions. Hans made that point very well. I think wherever you look, you've got easier conditions kicking in. And the way I think about this is it's really the benefit of easy money that we put in place last year really beginning to filter through. The transmission mechanism of easy money a year ago was not working. Now it is much more. Third point is I think we're seeing credibly some significant upward revisions to capital spending plans. I mean, again, one of the things that surprised us is that we expected CapEx to remain low for long. You know, everything else might do a little better, but no one was going to invest in this environment. Turns out that capital spending has actually come back a lot quicker than we thought. There's issues of sustainability, which I'll come to in a moment. Fourth point, housing collapses appear to be ending. Maybe not everywhere, but certainly in the UK and the US. The worst on residential construction appears to be behind us. Fifth point, the benefits of easier fiscal policy probably are showing through. I mean, we can debate when the maximum thrust from fiscal policy shows up, but my suspicion is it's kind of happening almost as we speak. We certainly know the US fiscal program really kicks in earnest between the middle of this year and the middle of next year. And then the final point I'd emphasize is I think there's a very good chance that labor market conditions are going to begin to improve. I mean, one of the reasons we've all whipped ourselves up into a real round of negativity here is that we're convinced that whatever happens, unemployment's going to 10% in the US and going to keep going up everywhere else. Well, actually, it's stopped rising in the US. Whether it'll happen or not is another matter. Whether it'll persist or not is another matter, but it already stopped rising. Germany this morning had its second straight decline in monthly unemployment. Now, you can say some of this is policy stimulus working and it's therefore a transitory phenomenon, but I come back to my point that the long run is really a series of short runs that accumulate to provide a better environment. So my main point here is the recovery is for real. I'll give a definitive yes, and it certainly has a good 6 to 9 months of legs to it. I think the key question we've got to ask is, are we going to double dip, or whatever that horrible phrase is? Is this going to be more like 1981 in the United States? Those who've got long memories, we had a recession in 1980, we recovered in 81, and by the end of the year we were back into recession. Are we going to get that sort of scenario? And I would say no, but I'm worried about three things here. What could give us that scenario, I think, is a combination of one or a combination, more likely a combination of these three things. First, Hans's point, the emerging markets don't deliver. That's possible. Who knows what can happen, but I suspect that's probably the least likely phenomenon. The second concern I would have is we just get another round of global financial turmoil. Lehman Brothers or something comes out of the woodwork and causes real trouble. There are two good bets to look at here for this, both of which appear to be not necessarily fully anticipated, but well thought about. One of which is collapses in Eastern Europe, especially in the Baltic states, and our friends at the IMF are doing their best to try and make sure that doesn't happen. But clearly there are issues of sustainability about some smaller emerging economies, and we know from sort of domino effects in the past that some small problems can accumulate into big ones. A second one is the very obvious point about commercial construction and commercial real estate and the financing side of that, and the potential for that, especially in the United States, but I think more generally, to add another down leg to the banking sector's difficulties. And I think that's something, I think of that as just a slow train wreck. It's almost unavoidable. We're going to get big problems. It's going to make the banking sector weak for a while. It goes back to Hans's point about growth helping banks rather than banks helping growth. But commercial construction is something, I think, its implications are definitely something to keep one's mind on. And then the third and possibly the most decisive risk here is the IMF, my gentleman friend from the IMF's point, policy gets tightened too early. We get premature withdrawal of stimulus, whatever. And I think the problem I have here is not so much that policymakers are idiots and they'll do this stupidly. It's that they may be forced into doing it by a combination of either market developments in the form of interest rate moves which of course you could say, well, that'll be the markets doing it rather than the policymakers. But I think the biggest concern is inflation. We see inflation nowhere on the horizon, but our ability to forecast inflation consistently over the last 10 years has been dreadful. Our errors have typically been on the high side rather than the low side. But I think as an economics profession, to pretend we understand the inflation process fully, I think is a little naive. And I think if we were to see an upside to inflation, possibly as the implication of this EM strength, if the emerging markets continue to boom in terms of domestic demand, it may have goods price inflation implications that then feed through. So that would be my final, my departure point, as it were, that on the risk side, my biggest concern to the risk of a double dip is the risk of inflation.
Thank you, Philip. Uri Dadush will be our final speaker.
Thank you very much. Fourth, after three brilliant presentations, let me see if I can avoid repeating many of the points and add some commentary. The first is, yes, we have a recovery. It is a nascent recovery. And you see it here in the Industrial Production Index for the world through the end of the second quarter. I want to make 2 points about this chart. The first is that the rise that you have seen in recent months, and this is by and large confirmed by the July and August numbers that we have, is actually about as fast, if not faster, than the decline, very sharp decline phase that we saw back in 9 months ago. The second point to observe is that the recovery is, of course, from very low levels. And this is significant because one point I want to make is that the recovery may be slow, as the IMF is predicting, but it cannot be too slow. The reason it cannot be too slow is that with levels of activity so far below previous levels, this is an indicator of huge strains in firms, in households, and so on and so forth. So a recovery that is very slow from these low levels is almost bound to be a recovery that falters. And now the greatest reason for optimism that it will not falter, in my view, is the restoration of credit. It is my view that having restored credit and confidence, that we're not going into a Great Depression, that banks can lend to each other again, etc., we are hopefully unlikely to lose that asset. And the fact that credit has been restored means that the natural healing mechanisms and restoration mechanisms that, of economic actors can be relied upon to take the actions that are necessary to take us back to something like an even keel. The greatest reason to worry that we are not going to have the recovery we need, the sustained recovery, is that, of course, at some point these gigantic measures of stimulus are going to have to be withdrawn. Now, hopefully, that is not an issue for now, unless there's a major policy mistake. This is an issue for 6 to 12 months from now. But 6 to 12 months from now, very important questions will arise about the ability of the private sector to take over from the public. And therefore, I subscribe to Phil Suttle's view that in the course of the next 3 to 6 months at least, the recovery should persist, and it may be actually a somewhat faster recovery in the short run at least than most are anticipating. Second point is that the sun rises in the east. It's in Asia that the recovery is most evident. The sun is out, according to these numbers, to a large degree. And we are sort of at the dawn in Europe with industrial production, just beginning to rise. And we are furthest back in the United States. This is actually somewhat the opposite of what we expected. We certainly expected the United States to be among the first to come out. And the reason it isn't is, of course, that the center of the crisis, and here I disagree a little bit from Hans' description, really is in the United States. This is where the financial collapse happened. And this is where the V-shaped recovery will have the toughest time, because the overextended consumers and the problems in the banking sector, and of course other countries in the same situation, UK, Ireland, are ones that you could point to. A couple of points on this chart. Provided exports no longer a drag on Asia, and they're not, according to the latest data over the last couple of months or so, then there really is very little reason to think that Asia cannot continue growing and recovering. Asia did not suffer a banking crisis. They do not have a lot of the structural and overextension problems that other regions do not. But the second point I want to say is that it is also a mirage to think that Asia is going to pull the rest of the world out. And again, I differ somewhat from Hans's interpretation, although I'm not sure that's exactly what he said. He'll have a chance to come back. But Asia is simply not big enough. China is not big enough, et cetera, et cetera. And the best way to think about the shape of the recovery is that the three main regions, Asia, US, and Europe, each will have to rely on their own restructuring and their own domestic demand. I think the rebalancing issue across regions, etc., is an overplayed issue, in part because it is essentially happening. China, etc., the parts of the world that can, are growing faster. Their current account surpluses are declining sharply. The current account deficit in the United States is declining sharply. More importantly, the oil exporters' surplus is coming down hugely. And this is all assisting this general rebalancing story. Also, remember that rebalancing is not about adding demand to the world. It is about redistributing demand to the world. So, of course, that is it's worth doing that, and there is a policy message that's worthwhile there, but it isn't, by any stretch of the imagination, I think, a central question in the forecast at the moment. Let me see if I can. Okay. Now, I do think that a central question in the forecast is how fast the financially impaired countries, I call them, are going to recover. And first and foremost, the United States as the largest economy. And here, I think that historical comparisons, while useful as reference points, and you learn a lot from the historical analysis that have been done by the IMF and others in this area, I don't think they should force us or straitjacket our interpretations. And that is because, in fact, situations are incredibly different. So if I was to look at the United States today, and I would say, well, the United States is a country that saw its exchange rate appreciate in the middle of a financial crisis. Capital went into the United States instead of going out. United States is engaging in virtually unprecedented policy measures to deal with the problems. And but most important, what I'm really impressed by is the reaction of the private sector in the United States, which kind of stands in sharp contrast to what happened in Japan during their banking crisis. And it's one of the reasons that I don't want to pay too much attention to these historical numbers. And here you see one manifestation of how, in fact, industrial production in the United States was cut back hugely relative to the personal consumption of goods. This is the other side of the big reduction in inventories that happened. It's one way to illustrate it, but you could also look at the enormous changes in the housing market, the big reductions in housing and the big reductions in housing stock for sale, etc. Another chart that is really impressive is these big declines, very rapid declines in investment and inventories. I haven't shown the big cuts in employment in the U.S. private sector, but then, remarkably, you have an improvement in profits, in corporate profits in the United States in the first and second quarter. Now, of course, this is the other side of the picture to the enormous pain that is being caused to the U.S. consumer and the lack of confidence, etc., that you see. But there is a positive side to this picture, and the positive side is that you have a large corporate sector in the United States that is in actually pretty good financial shape. And once the demand begins to stabilize, you are likely to get a very rapid response. And most notably, and here I agree with Phil again, most notably, you will quickly see a rapid response in the employment picture, and soon the U.S. consumer may be looking at a situation where employment is rising again and asset prices are appreciating again. And the U.S. consumer is not shy, as you know, and will also react quickly to this kind of situation. I just want to say one word about policy. My 2 minutes are almost up, I think. And that is the big question then is the withdrawal of stimulus 6 to 12 months down the road. If you actually look at the cost of the TARP program and the recovery program, the basically discretionary fiscal stimulus in the United States, it adds up to about something like somewhere between 5 and 10% of GDP. Of course, this is not actual outlays. Some of it is investment. Quite a bit of it is investment. These are cash flow figures. So the numbers really are quite a bit smaller than that. Some of that may result in profits, and is to a degree for the U.S. government. This is actually a very small part of the story of the accumulation of debt due to the crisis, which is anticipated to be in the 30% range, something like that, if the IMF forecast is materialized. It's a very small part of the story. The big part of the story is the effect of the crisis on revenues and taxes, et cetera, et cetera. I'm saying all this to underscore the point that withdrawing stimulus in these kinds of circumstances may actually end up costing more to the U.S. taxpayer than keeping the stimulus, which is a relatively inexpensive part of this crisis, going for another few quarters to make sure that we're out of the woods. Thank you.
I'd like to thank all four speakers for extremely content-rich presentations and for staying within their time limits. Let me take advantage of the position I have as moderator and kick off the discussion, for which we have about 1 hour with one initial questions. When the crisis began to break in the U.S. late 07, 2008, many commentators suggested that the developing world, the emerging markets, would not be so much affected by it because there had been a substantial amount of economic and financial decoupling. The reality turned out to be very different. After the collapse of the Lehman Brothers, I think the entire global financial system got sand in its wheels and triggered a global crisis, not only in the financial sphere but in the real economies, just about everywhere. What we are seeing now is that the strongest recovery, as many of you emphasized, appears to be emerging in the developing countries, particularly in Asia. But at the same time, these countries are talking all about promoting South-South trade, South-South investment relationships, as though they are intent on bringing about some degree of recoupling in the next round. What are your thoughts, if we can go around the table, on the prospect that perhaps in the next round, over the next 5 or 10 years, we will get a different global economy with a stronger bifurcated economic pattern? On the one hand, the South-South emerging markets, on the other hand, the old rich industrialized economies in North America, Europe, and Japan. Would anybody care to comment on that?
First of all, I think that decoupling is a little bit of an awkward word because it suggests that there are groups of countries that are completely independent, not integrated into the world economy. The opposite is actually true. What has happened over the last 15 years is enormous integration into the global economy. If you look at the cyclical part of production all over the world, it has been more and more synchronized. At the same time, I do think that trend growth in the developing world has decoupled from trend growth in the high-income countries for some time now. That for strong growth in the developing world, you don't need strong domestic demand in the high-income countries. In that sense, the developing world is no longer dependent on what is happening with the U.S. consumer, what is happening with domestic demand. What happened over the last 10 years is that as a result of very strong productivity growth, which was partly due to an integration into the global economy, partly due to domestic reforms, as a result of very strong productivity growth, there was strong growth in the developing world with a lot of investment that became, even on the demand side, a driver of global growth. As a result, they could penetrate into the global markets and into the markets of the high-income countries. That picture has not changed, not in the crisis, not in the recovery. And that was the background of my presentation, where I focused on a very narrow element. I don't think that the slowdown in the developing countries was because of a slowdown in domestic demand in the high-income countries. If that were the case, it would have taken much longer before it became apparent. If that would have been the case, then the slowdown should have reacted already to the slowdown in 2007 in the U.S. economy. That was not happening. What happened in the financial crisis is that the investment process that really supports that very strong growth in the developing world, driven by productivity growth, was interrupted. And the big question is, how long does that interruption take, and how strong is that recovery? Now, following up on that, it's a bit scary that we agree all the time, because every time we are surprised, but then in one moment in time we all agree. But I do want to say I agree strongly with the point that Uri made, that we are coming now from a very low level, and it is almost inconsistent to talk about a slow recovery. Because if you have too long a slow recovery, then that recovery will indeed fail, and you will have a double dip. You do need a return now to above trend growth to solve the labor market problems that have been created. You do need the private sector to take over. It is not possible for a substantial period of time to come now with very slow growth. And that means that the element that supported growth before the crisis has to return quickly. And that element is confidence in the private sector. That element is productivity growth. And the policy should not continue to focus on just spending. I don't think that the main danger is that the stimulus packages are stopped too soon, the main danger is that whatever can be done to further reform economies and to stimulate productivity growth is not being done. I think that was the main mistake during the 1990s in Japan. It was not that the government reacted too slowly. It was not that they didn't spend enough, but they didn't use the opportunity for further productivity increase, especially in their service and domestic sector, to boost growth again. Now, that is what needs to be done in the developing world, and that's where the big question mark is.
Thank you. Any comments on the decoupling issue in particular? But any other comments you will make on the presentations by other speakers is welcome.
Yes, a couple. 3 points on let's call it bifurcation. The first is emerging economies this time around have done better relative to the way they performed during previous financial crises in advanced economies. There is relatively little question in our minds about that. It's certainly true for the vast majority of emerging economies. There may be some in emerging Europe. We can talk about that, but that's a separate issue. I'm talking about crises that originate in advanced economies and spill over to emerging economies. And this time around, when that happened, they did much better than before. So there's something like more autonomous forces taking root in these economies. The second point I want to make is, though, that their fate is still inextricably linked with that of advanced economies and vice versa at this stage. It is the fear of a Great Depression in the United States, in the advanced economies, that brought the global economy to its knees in the final quarter of 2008 and the first quarter of 2009. So we are all closely related. And the third point I want to make, what over the next 8 to 10 years, it's clear that consumption in all of these emerging economies, in most of these emerging economies, is growing much faster than it is in the United States and in other advanced economies. So yes, they will become even more, their growth processes will become even more autonomously rooted than in the past. And so I would agree in that respect with Peter. Thank you.
Just, again, agree with most of what was said, and just to add around the edges a couple of pieces of color. First, I think there is a risk when we talk about emerging economies and mature economies and putting them into big lumps together. I think we are clearly in what I characterize as a world turned upside down, where the balance of economic power is shifting from the mature economies to, on average, to the emerging economies led by what our colleagues at Goldman Sachs famously call the BRIC economies. And I think, you have to credit them for their insight in seeing that it's those large domestic demand-led economies that are doing well and will continue to do well. But I think it's also important to recognize that a key aspect of this crisis, as was highlighted in the IMF presentation, are the big imbalances that built up, in a number of emerging economies as well as in a number of mature economies. And most specifically in Eastern Europe. And as I mentioned earlier, I think those problems are still ahead of us as much as behind us. But I think, when we discuss all this, I think it's just very important not to lose sight of the fact that the reason emerging markets came through this so well is partly because they had their own financial crises so consistently for much of the last 15 years and learned from their experiences. So they position themselves, I think, a lot more diligently going into this downturn than might have been the case in the past. A good example is the virtuous part of Latin America, Chile, Mexico, Brazil, Colombia, probably missed one or two out there, Peru, for example. Their ability to run autonomous monetary policy, independent monetary policy with a flexible exchange rate has been absolutely stunning in this environment. Uri mentioned how the dollar had appreciated in the financial crisis. Well, most of the Latin currencies actually appreciated. The Brazilian real actually appreciated quite on a trend basis, quite appreciably over the last year or so. Even as Hans' picture showed very graphically, the Brazilian real economy was hit very dramatically. It meant that the Brazilian central bank and other central banks in Latin America could cut interest rates and cushion their economic systems. So I think, this emerging market versus mature market relative performance is not in my opinion, not a mystery or not something that comes out of the fact they're low-income guys and they've got some catching up to do. It comes out of macroeconomic policy reforms and policy frameworks that have been put in place in recent years and have shown to be very, very durable in the last few quarters.
Well, I kind of have to almost. I'm kind of with Hans on this. We have cyclical coupling in spades between the North and the South, and we have structural decoupling, and the two really are entirely separate phenomena. The structural decoupling is caused by rapid capital accumulation, high rates of investment in the South, rapid technological catch-up, and more rapid employment, labor force growth in the South than the North. So the rate of growth of the South is much faster in a long-term sense than in the North. But we have cyclical coupling in spades because these economies are linked through aggregate demand in the short term, and as we have seen dramatically through international capital markets. And that's how you reconcile the two phenomena. The implication of this combination of cyclical decoupling and structural coupling, structural decoupling and cyclical coupling, is that over time the developing countries are becoming cyclically very important in determining what's happening in the industrial countries because their weight is increasing. And in the last few days, basically, as near as I can tell, stock market behavior has essentially been driven by the big changes in China's investor sentiment, which again is a relatively new phenomenon. By the way, just very quickly, the idea that we have a South-South and North-North world just doesn't add up. I mean, anybody who's looked at trade flows knows that the big complementarities are generally between North and South for all sorts of reasons, rather than South-South. And the possible exception to that is Asia, where, but again, it's not a real exception. That's more of a regional. There's a regional capacity within Asia because of the presence of both high-income countries in Asia and lower-income and middle-income countries in Asia to have more of an integration within Asia, but not in the rest of the developing world.
Thank you. I'm now opening the floor for debate and questions. The rules are very simple. Raise your hand, wait for the microphone, state your name and affiliation, and try to keep your question very short. Mr. Dahlman.
Thank you. Carl Dahlman, Georgetown University. Well, this is great, and I'm very surprised about how positive all four of you are. And I wanted to probe in two areas. One thing that you gave very light treatment to is the whole sort of banking and money supply injection, especially in the U.S., and that has been a very important part of this recovery and stabilization. The real question then is, how is that going to work out in terms of how the U.S. will be able to finance its very large and growing deficits, taking into account things beyond the crisis in terms of the pension? And is the world going to be able to finance that, given that they're losing confidence in the dollar? So that's one question. The second is, with respect to the interest rates, it would seem that we're coming out of a period where interest rates were very low, and now that we're going to be pricing risk higher, interest rates will be higher, and that will mean lower investment, and that's another factor for having lower growth in most of the world, except perhaps China, where they have a lot of their own internal financing. So I wonder if you could address both those issues. Thank you.
Is your question addressed to any of the members in particular, or no, whatever? Who would like to respond? Two questions.
Very brief on the banking and budget deficit side in the U.S. I mean, I think the so-called exit strategy on the monetary side, I think, has an element of automaticity about it. And then there's obviously an element of pure policy decision-making. The automaticity point is already in action. For those who follow the Fed's balance sheet closely, the Fed's liquidity injections have fallen by something like $800-900 billion over from the peak in the fourth quarter of last year. What I really mean by that is especially all the international central bank swaps that the Fed was doing to essentially provide financing into Europe and other parts of the world. Most of those have been unwound, as has had many of the emergency liquidity facilities. Now, the Fed's balance sheet overall has remained broadly unchanged in that time. So what the Fed's been doing is substituting a push of money into the system for, if you like, the drift of money coming back that the private sector's returning. And that really reflects primarily, in fact almost exclusively, an effort to get the mortgage market going again. And I think one of the sad facts of the last year or so, the last few months, is the U.S. mortgage market remains very moribund. We've got a broken system here, and not much is being done to mend it, with the exception of the Fed really trying hard. My suspicion, however, my strong suspicion, is once the mortgage market does begin to improve, and it'll, unfortunately, it looks like it's going to be last in line rather than first in line, it won't be too difficult for the Fed to unwind that as well. So I don't wish to sound too Panglossian here and everything's going to be fine, but I think we've got bigger problems that I'm going to leave my colleagues to talk about when it comes to exit strategies in some of the other areas, most specifically on the fiscal side. But I would say the monetary exit strategy for the Fed is, I think, easy to see and relatively easy to manage.
I'm going to take the question on fiscal deficits and interest rates. I mean, for the moment, you're not really in an economy where private and public sector are competing very hard for funding. The demand for funding by the private sector has declined immensely because investment plans have been scrapped and so forth. And basically, the public sector is stepping in to provide demand and is using the funds that are available. So you don't have a lot of upward pressure at this stage on interest rates from fiscal deficits. Clearly interest rates would be lower if there hadn't been any fiscal expansion, but investment would be lower still. So don't think that effect, the demand effect is much more important for investment than the interest rate effect. I think the question becomes quite pertinent when we go forwards. As autonomous demand starts growing, then the private sector will again compete with the public sector for funds. There will be upward pressure on interest rates, and that's also the time at which fiscal deficits will have to be rolled back. And with the political economy pressures around, I expect that this will happen because the appetite for deficits is actually not big at all.
Judd Harriet, documentary film producer. My question may have been answered by Philip, but I'd like to ask again, given the huge increases in the monetary base as a result of Fed balance sheet activity, and again addressing exit strategy, do all of the members of the panel feel optimistic that the Fed can orderly sop up this liquidity as the economy rebounds to avoid inflation?
The answer is I agree fully with Philip. Yes, I do feel confident that the Fed can absorb this money. It can introduce, for example, time deposit accounts. It can introduce reverse repurchase instruments. It's already paying interest on deposits. So the technical means to absorb this are effectively there. And so we are not concerned about this triggering inflation in the medium run.
Can I? I agree that technically all the means exist. After all, technically the means existed to triple the balance sheet of the Fed very quickly. The means exist for for cutting back the supply of money and the supply of credit relatively rapidly, technically. The problem, in my view, is not the technical issue. The problem is, number one, the timing question, and number two, the political question. The timing question, I think, is going to be very, very difficult. I mean, for example, right now, Israel, little Israel, decided to raise interest rates, the first to raise interest. This is like made major news. And suddenly people are very concerned, and they're very concerned about Australia raising interest rates. So there is an issue about when this is done and how it is done in the United States, and whether confidence is sufficiently robust to withstand it, to withstand this major piece of news. So that's one question. And the second, which is related, is also the political question. And this is linked also to the size of the budget deficit in the United States. It's going to be a lot tougher for the Fed in a situation where you have very large budget deficits, because basically, very quickly, it is going to be confronted with either a crowding out problem, if it raises interest rates, et cetera, as private and public sector clash in the demand for credit, or with expectations about inflation. So actually the game that has to be played is not just a game for the Fed, and it's not only an international game that has to be played, but it is also the link between fiscal and monetary policy and the withdrawal of stimulus along both lines, which is very complicated. And that's why I didn't have time at the end of my presentation, but that's why I agree with Jean-Claude Trichet, who said, we may be getting better, but it's going to be a very bumpy road ahead.
It might be my ignorance, and Phil and Jörg might know a lot more about the Fed's balance sheet, but this would be one of my main worries, actually, that we don't have an orderly exit strategy. And that is especially for the reversal of the quantitative easing, and that's for two reasons. First of all, we don't have a lot of experience with that. There are not clear rules on how and when to do that. It was all done in an emergency mode, and to reverse that is very different from reversing just standard loosening of monetary policy. And the second one is the point I think that Uri also made, is that what basically the Fed will do if they start selling the securities, the government securities and the corporate securities again, is immediately interfering in the markets. And that is at a time when the financing need of the government and the financing need of corporations is very high. So I do see a problem there, and for me the main risk is that for too long we will have too loose monetary policy in the United States. I'm much more worried about that than about the fact that at some point the cost of capital will increase because the risk premium will go up, because I would see that much more as a return to normal and something that is needed for a recovery.
If I may, just to add a point addressing the gentleman's concerns, I mean, I think there's a very helpful rule for addressing U.S. monetary policy, the famous Taylor rule. And there are two episodes where clearly the Fed, based on that rule, was too slow to raise interest rates. One of which was after the 1993-94 episode, when we had rates at 3%, the Fed was too slow. And the other one, most importantly, was in 2002-2003, after when the deflation scare was in place. And I think that reminds us that the Fed has a pretty bad track record. It tends to move in recent history too slowly. Now, based on the Taylor rule at the moment, interest rates, we estimate, should be something like -2%, -3%. They obviously can't be at that level, so the Fed has to do this quantitative easing. But I think that rule is a very important thing to track. It's based around inflation performance and the unemployment rate, essentially. As that rule brings rates back to zero or into positive territory, it will be very important to see the Fed responding to that and not, as Uri would suggest, delaying, based on politics and concerns of market disruption. The final point I'd throw out here is maybe what we should be most concerned about with this U.S. monetary policy is not its implications for the U.S. and U.S. inflation, but its implications for possibly creating the next bubble elsewhere. And that's not just true of the U.S.'s monetary policy, it's true of Japan, it's true of the euro area. One of the things that really worries me at the current time, we're all espousing this view of emerging markets being the great new dawn. Well, average interest rates in most emerging market economies are probably 5 or 6%. They're zero in the G3. With that degree of carry, with that degree of interest rate differential, there's tremendous potential for a lot of short-term capital to just consistently flow into emerging economies, much of it untracked by the data, creating the next problem that we have to deal with in 5, 6, 7, 8 years' time.
The gentleman introduced himself as a filmmaker. If by any chance you're planning a movie on monetary policy and the unwinding of the Fed's balance sheet, we would love you to show it here. Next gentleman here in the front. Wait for the mic, please. Yeah.
Dev Carr, former senior economist in the IMF, now lead economist at Global Financial Integrity. My question to the panel is that how likely is there of a change in the international monetary system away from the dollar into an international basket currency like the SDR? There was an article recently in the Washington Post by Professor Joseph Stiglitz raising this kind of concern. And how likely is that to throw a monkey wrench into all these projections? My own take is that it's not very likely in the medium term, but I would like to get the reaction of the panel. Thank you.
That's more your subject.
Well, he's from the international. I'm afraid I don't have very original thoughts on that one. I mean, reserve composition is something that changes very slowly. But it's been changing, and yes, what I would expect to happen over the next decade is that all central banks will increase the share of reserves they hold in emerging market currencies. But this will be a very, very gradual process, very slow process that will almost not be perceptible to the naked eye, just as it's been over the past decades. So I don't expect this to throw a monkey into our projections for the next 3 years.
Any other views on international monetary reform?
I'll just very quick, because it takes us off, I think, the main topic. I agree. I don't think it's a major issue for the projections. The second, I don't think that there is a valid alternative to the US dollar as a reserve currency in the foreseeable future. Neither the euro, nor the yen, nor the yuan are likely challengers the euro at the margin has been around, but likely challenges in the near future. I mean, the next 10 years or so. And on the SDRs, I don't know. Does the United States want to give the decision on how much reserve currency to create to the International Monetary Fund, extraordinarily competent as they are? And I'm not sure, do the developing countries want this, or some developing countries? It just looks very far-fetched to me.
Very quickly.
Sorry.
I agree that it's a slow process. It started already before the crisis. It will take another 10 years. At the same time, I do think that 10 years from now, when there is a much more multipolar world, when you have a lot deeper financial markets in Asia, a lot more direct intermediation of the savings in Asia to investments in Asia, and a diminished role of the dollar, that people will say that that is one of the permanent impacts of the crisis that we're seeing now.
I'm chairman, so I'm not a member of the panel, but on this subject, I think one perspective is what is likely to happen, and I fully agree with the speakers that major change seems unlikely in the foreseeable future. But another question is, what are the dynamics that have been put in motion by the opinions expressed in China, but also in Brazil. In fact, almost all important emerging countries have publicly expressed support for the reform proposals that have emanated from China. And I think that's not to be ignored, because these people will do what they can to try and bring about some reform, even though it is unlikely to materialize anytime soon. So, next question, the gentleman in the back. Yeah.
Barry Wood, freelance correspondent. I wonder if the panel could give their views about U.S. economic growth for 2010 and 2011. And for you, Jörg, I'm intrigued by what you said about current account deficits constraining demand in the United States and Eastern Europe. I see the logic to that, but I wonder if you could speak further. Does that imply that you're thinking there would be a substantial devaluation of the dollar to accommodate a reversal in our current account deficit? Because it seems to me that past experience suggests that we're really not impacted in our consumer demand by a large current account deficit.
On the U.S. forecast, on the U.S. forecast for 2010, we will be coming out with new projections in about a month's time, and so I can't give you an exact number now. I would refer you back to the U.S. staff report, which we issued about a month ago, to look for numbers there. On the question on the current account deficits, I mean, it's clear that what you see, what has already happened is that household savings in the U.S. have risen. Household savings will also rise in a number of other economies, such as the UK, Spain, Ireland, and many Eastern European economies, whose combined current account deficit is almost as large as that of the United States. And the savings are rising because people have lost assets, because people's expectations about income growth in the future have been scaled back as a result of this crisis. And that will hold back demand in these economies, and that will slow down the global recovery. Inevitably, as you are switching from domestic demand-driven growth to somewhat more externally driven growth, right, this is typically accompanied by a change in the exchange rate in real effective terms. And that's what we would expect to happen over the medium run. Now, this can happen in various ways, right? I mean, it can happen in nominal terms. It can happen with the nominal exchange rate. It can also happen with inflation differentials, right? And all of these will be operating over the next few years. That said, I should say that our assumptions for our forecasts are typically always, and many others are doing the same thing, that assume that the real effective exchange rate stays actually unchanged.
Yeah, my name is Robert Lerman. I'm a professor of economics at American University. And I find it a little bit strange that the emphasis is almost entirely, with some exceptions, on flows as opposed to balance sheets, given the fact that the sectoral balance sheets, the corporate sectors, the banking sectors, government sectors are all intertwined. And this intertwining of these balance sheet shocks played a big role in, quote, the financial crisis. And after all, we've been all referring to it as a financial crisis. What do you see in terms of, let's say, corporate and banking balance sheets as overall, in terms of both the United States and, let's say, other developing countries? We've already heard that the emerging countries are in better shapes, but maybe you could say something about that as well.
No, I know nothing about balance sheets. But I mean, the beauty of balance sheets, of course, is they all balance and they all add up. In fact, there's a wonderful, I'm sure you've all heard this, but there's a wonderful quote. I think Jacob Frankel was using it a lot last year when he said, well, you know, the great thing about the international banking system is on the left-hand side, there's nothing right. And on the right-hand side, there's nothing left. So we're all balanced, so we're okay. And that was a good line at the depth of the left-hand side is the assets, the right-hand side is the liabilities, by the way, for those who need some help. But you know, I think the danger with, you know, dealing with identities is, you know, trying to sort of strip out causality effects. And I mean, I think the right way to think about what we call the crisis is there's two episodes. I mean, in a sense, it's the financial counterpart to this decoupling synchronization story we've been talking about. The first phase was, I guess you'd call it a crisis, but it was really a period of fairly significant forced balance sheet adjustment on the part of the global banking system, but especially in the United States and Europe. And that began in the middle of 2007. You could say it began a little earlier, but it really kind of became evident in the middle of 2007. And went through to August, September 2008, when it stopped being that and it became a panic. So we had a crisis phase, and then, or an accelerated adjustment phase. Then we had a panic, and in that panic phase, not much net change occurred, to be honest, but everything just collapsed. Everyone wanted to go to ground, go to zero. You know, no one wanted exposure to anyone else. And that's where the central banks became so important, because they were the only people that anyone would be willing to take exposure to. So we actually had a bizarre situation that could have gone on for a long time. It didn't, where the central banks effectively became the intermediaries in the financial system. Now that panic phase, my estimation, ended in probably January, February, but certainly by early March was over. So we had sort of about 4 or 5 months of genuine good old-fashioned 19th century panic. And now we've returned to, you know, this phase, call it a crisis, but I think it's best thought of as a phase of steady accelerated balance sheet adjustments, where certain key creditors have got too much exposure to certain sectors and they're trying to work it down. Others, we would hope, are building up exposures elsewhere and can thus provide compensation in the form of overall global credit growth. It goes back to Uri's point that you want to keep overall global credit growth going, but you want to sort of reallocate it away from the guys who had too much towards sectors, you know, for example, private creditors and private borrowers in China, who maybe you want to gain more. So that's to me the right way to get one's mind around what I think you've very correctly identified as balance sheet adjustment. To me, it leaves the important underlying message here that the worst thing to do would be to try and push exposures in places where they need working down. In other words, we don't want the US consumer to take on more debt. We don't want the US banking system, to be brutally honest, to be adding leverage. We want actually, you know, I would say a way of measuring success in the next few months is actually for us to be able to sustain growth whilst US banks continue to rein in credit. Sounds like no one else is saying that. Everyone's saying the opposite, but that's the wrong way to think about it, in my opinion. We need to see a successful deleveraging. The banks need to get smaller. They need to be recapitalized, and the only way to do that, who wants to buy bank equity here today? Who wants to buy a new issue of bank equity? No one. The only way to recapitalize the banks effectively is for them to earn their way out of this and to deleverage. And that will be the way we establish more normal medium-term growth conditions.
Yeah, let me follow up on this very important description of you had already a period of adjustment starting at the end of 2006, beginning 2007, and then suddenly you had the complete collapse and the panic. Let me link that to the previous question on the current account deficit and the imbalances. I would not be that confident that now easily we will see a further adjustment of the U.S. current account deficit, and we are in the process of unwinding the global imbalances. I think in that first period that Phil described, there were actually fundamental forces in play to unwind the global imbalances by reducing the spending and the credit in the U.S. economy. It didn't show up immediately because you have those processes that it takes time, and at the same time you had the dollar rising a lot, as a result of which the current account deficit was not reduced as much as you would expect. Now we see a sudden reduction, but I would argue that the fundamental forces are perhaps not that strong. And basically what we are seeing is a big impact of the fall of the dollar, but at the same time you don't have that continuation of the orderly adjustment process that you had before, and you have the U.S. Government that is spending a lot. Once you have a global recovery and the oil prices are going up again, and you don't have the exit strategy on the fiscal policy, I'm not that sure that we see a quick unwinding of the rebalancing of the.
That lady first, please.
Thank you. Xiong Min from 21st Century Business Herald, a newspaper in China. This is a good time to do assessment of the economy because by later this month we're going to have the G20 summit in Pittsburgh. So, after the panel's assessment of the status of our world economy right now, what kind of policy actions should we expect from the G20 summit? Then a follow-up question to what Jörg just mentioned about China's role in leading the world economy out of this recession. You think China cannot play a big enough role? And can you explain this to me in figures, why China is not big enough to lead the world out of this recession?
First, China is playing a big role in sustaining world demand. They have expanded their they've moved into a large fiscal deficit. They've stimulated the economy, and you've seen it actually in Hans's figures that imports in China are rising quite rapidly. So China is doing its part to help pull the world economy out of the recession. Can China do it alone? No. I think everyone will have to do their part in order to get back to a sustainable growth, a healthy sustainable growth rate. And the figure that I mentioned was that if you take the consumption of China and you compare it to consumption of the US and consumption of all these current account deficit countries that I mentioned, it's a long list, starting with the UK, including Spain, Ireland, and then many emerging European countries. So you take the consumption of all of these countries, and then you compare China's consumptions with it, then China's consumption is 25%. So China alone cannot do it. Everyone has to play their part. For the advanced economies, it means more structural reforms, especially more efforts to repair the banking systems. That's absolutely critical. And then there is also tasks for the emerging economies, where more needs to be done in order to reform corporate governance and also financial sectors to support consumption and improve the allocation of investment so that you can get more sustainable growth. There may also be a case for some emerging economies having to look at whether there are distortions in place that foster investment in tradables rather than non-tradables. And that's an issue that also would have to be taken into consideration. But, it's really a broad set of tasks for a broad set of players that is called for.
Just for clarification, to assess the importance of China or any other countries, you don't look at shares, but you look at their contribution to growth. When you're 25%, but you're growing twice as fast, you are as important as another country that is 50%. If we look at contribution to growth during the boom period, then developing countries were way more important than the high-income countries. I try to argue that also in the downturn, the contribution to the downturn from the developing world was larger than from the high-income countries, and I'm convinced that that's true also in the recovery.
You asked another part of the question about the G20 and what they should be doing. First of all, I think that basically the G20 are in terms of mitigation, crisis mitigation policies, doing pretty much what they need to do. And actually, I think history will judge very kindly the crisis response effort in this direction. And so the main job there is really to take stock and monitor, but also, in my view, to underscore the point which I think every one of us made today, I believe, maybe Phil not, but the point that Phil forgot, but the point that policies have to persist. These stimulus policies have to persist until we are certain that we are out of the woods, and it's a lot more expensive to make a mistake withdrawing too early than withdrawing too late, in my view, in the current context, my view. So I think to underscore that is very important. But second, to also underscore that people need to have an exit strategy, etc., even though the exit strategy is not implemented now, that the articulation of exit strategy and coordination and discussion about the global repercussions of exit strategy be on the table. That's as far as mitigation goes. I think where the world is falling very seriously short now is on the next crisis, which is how do we prevent the next crisis? And here, I think on the question of financial regulation, I'm not an expert on financial regulation, but my sense is, from talking to people, from reading, etc., is that far not enough is happening in that direction. There are very good reasons. It's complicated. Above all, the political resistances are enormous. These are very powerful players. The players that Phil represents, for example. But these are very powerful players, and so I don't think enough is being done in that direction. And the G20 may be able, and I know that the Europeans intend to raise it, or some of the Europeans may be able to do more than has been done. And I think equally, although this is a subject that the G20 studiously tend to avoid, I think there needs to be, as there was some discussion of as the Jackson Hole symposium, discussion about the appropriate role of monetary policy in the stopping bubbles emerging. I mean, I think the idea that, monetary policy just concentrates on controlling inflation, doesn't worry about the broader systemic risk issues, doesn't worry about financial asset bubbles, doesn't worry about housing price bubbles. I think that's sort of, completely punctured. That theory is very seriously punctured by the crisis that occurred. So there is a very serious set of issues that needs to be examined in that direction. The G20 tends to stay away from it because monetary policy, remember, is supposed to be independent in a lot of places.
Very quickly, may I? Sorry to interrupt so often, but one other point on the G20. The focus of this G20 will be on the low-income countries, and that focus is long overdue because we are not talking about it. They are not that important in the global economy, but there is a danger that the long-term impact will be largest for those low-income countries because they are most vulnerable. They are vulnerable because they don't have the domestic resources to react to the crisis, but they are also vulnerable because in many of those countries, especially in Africa, the reforms that have produced an acceleration in growth were very recent. And in many of those countries, there's a backlash now, so they need a lot of support.
You have a follow-up question to this?
I just wonder if...
Could you wait for the mic? Normally we don't allow follow-up questions. We make an exception.
Thank you for making this exception. Just wonder if York from IMF and Philip from IFS, I guess, IFC, agree with what are the priorities on the G20, or if you have something else to say.
I think Hans has stated what the priorities of this G20 are. The focus will be on low-income economies, and I do agree that these economies are facing major challenges. That years of work in terms of poverty reduction are being put in peril by this crisis, and therefore, this focus is appropriate.
If I may put in 2 cents on the China question that you raised, I've been looking at it a bit. It's my impression that China's stimulus program, which is largely monetary but also fiscal, is probably the largest and most comprehensive in the world, certainly in relative terms, and also one of the most effective. It kicked in fairly early. China didn't have an over-leveraging problems. The banking system is relatively strong. And it is remarkable that most of this emerging market growth that we are talking about is accounted for by China. China, in fact, accounted for most of global growth in the first half of this year. It's extraordinary, the importance. But that doesn't mean that China is going to remain a principal motor of recovery. Ultimately, the U.S. and the rich countries have to come back, as Uri, I think, stressed. Because if you look at the composition of China's growth in the first half of this year, it's all investment. It's all government-driven, credit-financed investment. The investment rate in China was already high in recent years, over 40%. You know how much it was in the first half of this year? 87%. A totally unsustainable picture, of course. China investment demand, government finance, compensated for the drop-off in external demand and more than compensated for more than that, but it is obviously not a growth pattern that can continue for long. Next question. Bert?
Thank you, Bert Keidel. I'm an independent development economist. I used to manage the East Asia office at the U.S. Treasury Department. There's a theme underlying a lot of your positions that I would like to ask about. And Philip Suttle teed it up when he talked about the deleveraging process. And I was surprised at Hans Timmer's statement that the crisis was not only going to be solved by emerging markets, but actually was, in a sense, caused by their early downturn. And for you, I would ask, didn't that, if I'm mistaken, your analysis rely on trade flows when there are a lot of indirect trade flows? That if you look at Asia trade dropping, it was an anticipation of U.S. decline or dropping U.S. orders, which were still being filled in China. And then those trade flows kept going to the U.S., but the trade flows to China actually dropped precipitously because of the anticipation that the U.S. demand and European demand were clearly collapsing. And so there's the issue of causality here. We're not talking about balance sheets, but we're talking about ex-post trade patterns or ex-post growth patterns, where the liquidity growth in the United States due to deregulation, which brings us back to Uri's point about going forward, that liquidity in the U.S. was a major driver of the current account imbalances and the imbalances globally. And many researchers have pointed that out, that you don't get the global pattern of surpluses if the imbalances are due to one country or another. But could you again go over why you think that the emerging markets were so important in this crisis in causing it, and also why then they can have the gravitas to pull us out of it? And related to this issue, this demand factor from the United States that I'm not sure has been played enough, and not due so much to monetary fiscal policy, but due to deregulation and the leveraging that caused, is the treatment of productivity growth as if it's an exogenous, sort of an independent factor that we can work on, when ex post, a lot of productivity growth is also driven by what had been demand patterns in the world, when you get labor productivity growth and even what looks like TFP growth. So I wonder if you all could comment on the role of the U.S. demand from the liquidity growth, both in consumer and non-consumer, from deregulation, and how that, as a driving causal force, would look like a lot of the other things that you're using as causes of the crisis and potential solutions.
There's indeed an issue of causality here. I never meant to say that the crisis was caused by developing countries. This is clearly US financial crisis that through the financial markets spread to the rest of the world. What I try to say is that if you try to understand the patterns of production and trade, then it is good to realize that everywhere in the world domestic demand fell, but it fell strongest in the developing world. It is especially fell strong in those countries where investments are very important because they are a big share of the economy, important because they used to grow fast because of the crisis. And that is what you saw, that the decline in investments in the developing world and the drawdown on the inventories in the developing world was a major force in understand the slowdown in production and trade, as a result of which import demand fell much more in developing countries than export demand. As a result of that, it was especially countries like Japan and Germany that took a big hit through their export channel. Now, even then, of course, there is the question of causality. Did people in developing countries stop investing because there was a credit squeeze, because there was suddenly the panic in all the financial markets, or did they stop investing because they anticipated a further fall in domestic demand in the US and high-income countries? Irrespective of that answer, I think you can at least conclude that you won't have a global recovery if not that investment process that had been so important is restored in the developing world. And what you can also see is that developing countries, and especially Asian economies, have been able to keep up their growth and to keep up their investment in 2007 and the early part of 2008, when the domestic demand in the United States already showed sharply when there was no growth in import demand in the United States. So it is possible to have that process going even without a lot of demand stimulus in the US economy. And that's, I think, by itself an important observation.
Any other comments? On the productivity issue linked to demand?
I'm not sure it's answering your question, but it's a point I'd like to make, which gets this whole issue of potential growth, and by implication there's a productivity point in there somewhere. I mean, I actually think we're kind of fools as economists because we keep going on about this term potential growth with great degree of confidence. We even use it to measure something called the output gap, which we then use to forecast inflation. And given that it's all completely unobservable, I'm bewildered at times at how much reliance we put on it. But I think one thing we're often suckered into is a recognition or a belief. Essentially, potential growth is a purely extrapolative phenomenon, in my opinion. What growth has been in the last X years tends to be what we think potential is. And when growth gets pumped up by good things, maybe that's okay. But when it gets pumped up by excessive credit growth, as it was in Japan in the 1980s, and as I believe it was in the US in the years 2002 through 2007, we tend to assume that that can be sustained forever. And we're actually remarkably slow in waking up to the reality that not only has the so-called crisis caused a lowering of potential growth, but in fact that's a completely wrong way of reading it. What actually happened was potential growth was much slower all along than we realized, and the only way we could keep this growth going at these high rates was by throwing more credit at the problem. And once that credit began to go away, we're left with a much tougher reality. And that's just my way of saying that I think just as in Japan in the 90s, we had to get used to a much lower rate of growth on a trend basis than anyone conceived of in the early part of that decade. And it actually took a remarkably long amount of time for people to adjust their expectations down. You look at the OECD's estimates of potential growth for Japan in as late as 1994-95, they were still up there at 4%, in line with the 80s experience. And my strong suspicion is we're going to go rerun through that in the US, that there's going to be this expectation that the US can grow at 3.5% on a trend basis. And that's not going to be possible, I don't think, especially given some of the demographic factors which are also kicking in that add to a more legitimate downgrading of potential growth. So I think the whole linkage between credit and productivity and credit and potential output, I think is probably one of the least understood but most important things to get one's mind on.
I think we have room for one, possibly two questions. This gentleman. Yeah.
Hi, thank you. Juan Martinez, Economic Counselor of the Embassy of Spain. I just wanted to ask the opinion of the panel on a thing that I think that you didn't mention, that is, if do you think that the development of the Asian financial markets since the 1990s up to now, and or the exchange rate policy in many of these countries regarding the accumulation of reserves have something to do with this quicker rebound of the economies, or maybe it's just a coincidence? Yes, thank you.
I would like to...
I'll just make the point I made earlier, which is the emerging markets in aggregate, but especially those countries, put themselves in a much more sound financial position. Obviously, in the most extreme case in China and some of the other large Asian economies, giving themselves a buffer that then boosted their credibility in the financial markets. So I think that the point is well taken, that the response to the last crisis helped them this time around, and it will be a point taken looking ahead. You should expect emerging economies to want to build more, not fewer, foreign exchange reserves, and it almost gets back to the discussion about the international reserve currency issue, because certainly the demand for international reserves in whatever currency is going to go up, not down, in my opinion, over the next 5 to 7 years.
We've looked at this issue and tried to distinguish, to what extent was it reserves or stronger fiscal policies and lower inflation, therefore more policy room for maneuver that helped these economies to weather this crisis better. As with all economic studies, it comes with large confidence intervals and huge amounts of uncertainty, but we found so much stronger evidence for policy room for maneuver having played a bigger role than reserves. And you could see, there's a whole range of emerging economies that have come through this crisis better than during earlier crises, and some of them have piled up a huge amount of reserves, others much less so. But that is not to dismiss the importance of having some reserves.
I think we are approaching the end of this session, and I think the audience would join me in thanking the presenters for, I think, is an extremely rich set of issues and commentaries on a subject that is as difficult and as complex as it is important for all of us. So I'd like to ask you to join me in thanking the presenters and to close the session.